Hello everyone, welcome to our Accounting 210. In this video, I will review the chapter 7, 8, 9, so you will be prepared for our exam 2. One thing I want to first say is I have posted this guideline to the Blackboard. There are totally how many pages? Let's see, 7 pages. It's just the guideline. Some questions are not covered here, or the guideline covers more than your question. As I say, I will email you the detail about each chapter, how many multiple choices, actually definitely by Thursday. So I'm still working on that. Sorry, I'm kind of slow. And then also talking about, I also posted a multiple choice. Those questions practice in the Blackboard. I think maybe around 40–50% will same concept, from that. But this time is a little bit different actually. I want to first warn you, you don't expect like as many similar questions as your first exam, because I don't know what to say, but it's online test, so I have to change some questions, Oh well, so let's go to this guideline. Okay, so let's go to this guideline. Chapter 7. Chapter 7 talking about CVP analysis. I believe I assume most of you like this chapter. I think the concept is straightforward. Our exam will be open book, so make sure you read your textbook, get all of your notes ready. Do whatever. When I talk about open book, it doesn't mean, hey, you have this 1 hour to read the textbook. Do not do that. You have to know already your textbook very well. Just double check your memory when we talk about open book. So anyway, CVP analysis, why we call it CVP analysis, is cost, volume, and profit. So as a manager, you want to know, hey, what will affect our profit, right? Because that's the most important thing. We kind of prove that, hey, cost will affect it, volume will also affect it. Very important CVP analysis. We do this CVP income statement. The big difference is we separate our cost based on variable cost and fixed cost. So we have one concept, important concept called contribution margin. We see this CVP analysis only used for internal use. For external, we still use our absorption costing. Revenue minus cost of goods sold gives you gross margin, minus all of the period costs gives you operating income. CVP analysis is used in chapter 7, CVP analysis, and chapter 8, basically short-term decision making, relevant information, remember. So I put 2 columns here. General idea, revenue minus variable cost gives you contribution margin, minus all the fixed cost gives you operating income. So you say, hey, why you put this column too? Because this one is the total amount, right? So total amount, maybe the question said, your total revenue is 500,000, your total variable cost is 300,000, blah, blah, blah. But it's also possible the question gives you that your selling price is 50,000, your selling price is $50, let's say, and then you sold 10,000 units. So you have to be able to get the total revenue is 50,000 times 50, what do I say? So you have to use your selling price times your total units sold to get your total revenue. So this is kind of a per unit. How do you convert from per unit to total amount? And then you also use variable cost for each one time your total units get your total variable cost. You can get total contribution margin. You also can get contribution margin for each unit. And then question usually tells you total fixed cost, but it's possible tells you, hey, each one is what, and then you time the units. So you should know the total amount. You should also know from per unit, how do we convert, okay? You think it's silly, but yeah, it's kind of silly. Anyway, contribution margin for each one, contribution margin total. We said that the concept of contribution margin is important. Why we call it contribution margin? We don't call it whatever margin, because is the dollar amount that will contribute to first cover your fixed cost and then to contribute to increase your operating income. So we next one, contribution margin percentage. Since it's open book, I don't really worry about this formula. So just make sure you understand the concept. The contribution margin percentage is contribution margin for each divided by your selling price for each. Or if you use total, will be contribution margin total divided by your revenue total. What's the meaning? Contribution margin, let's say contribution margin is 30%. Okay, let's say contribution margin is 30%. Whenever you sell one more dollar, 30 cents will go to contribute to cover your fixed cost and then to increase your operating income. So if contribution margin is 30%, then your variable cost will be 70%. So you definitely will have a question. You at least one, I don't know how many, but you definitely have a question asking you something related with the contribution margin. Okay, make sure you kind of get this part. Second one and the third one, we also talk about break-even point and then targeted operating income. So as I say, you have this formula. That's a nice thing, very nice. You know, you don't need to try to memorize. Break-even point is most likely asking, hey, how many units you have to sell to get break-even? What's the meaning of break-even? Break-even means your operating income is 0, so your total cost is the same as your total revenue. It also means your contribution margin minus the fixed cost is 0, so contribution margin equals to fixed cost. I'm not going to read this formula, but if it's asking about units, you use contribution margin for each. If it asks you, what's your sales revenue dollar amount has to be to reach break even, then you can either use the contribution margin percentage or you use the break even point from the unit and then times the selling price. Sometimes the manager are not just satisfied with a break even point, they want to earn some money. So they said, oh, I want my target operating income is 100,000. If this is the case, your numerator will become fixed cost plus your operating income and then divided contribution margin or contribution margin ratio. We said when it's the break-even point, your operating income is 0, right? So when it's break-even point, your numerator is fixed cost plus 0, which will be fixed cost. But if you want to earn some money, 100,000, then you just put 100,000 as the numerator. You will definitely also have a question from break-even point or target operating income. Okay, so you definitely have a question from there. Next one, 7-4, talking about changing business conditions. Different methods, we talk about two main things. First one is how will the numerator denominator change and affect our break-even point? We say it's a fixed cost divided by contribution margin, get break-even point. So I say, hey, everything else is the same. If you increase your fixed cost, will you sell more or less units to reach break-even point? You should know your numerator increases, you have to sell more units. It also makes sense. You think about that. If you have more fixed cost to cover, then you have to sell more units, right? And then textbook gives you different situation. One is selling price increases, variable cost increases, fixed cost increases, what will happen to our break-even point. And another thing is when you change one of the numbers, so let's say you change your sales, the other thing is because of some reason, you know, your product is getting better, so your volume increases. When your volume increase, right, you used to sell 100 units, now you sell 120 units. Volume increased by 20%. If your volume increases, your revenue will increase because revenue is the selling price times your volume, right, times your units. Your units increases, revenue will increase. But variable cost will also increase. Variable cost will also increase because total variable cost is variable cost for each, which is constant, but your total units increase. So your total variable cost will increase. Your total variable cost will increase. Some students make a mistake is they just remember, oh, your revenue increases, but your total variable cost will also increase. And then your revenue increase, variable cost increase, contribution margin will increase. So if the fixed cost is constant, then your operating income can increase. Just, you know, I think we make sure there are definitely calculation. We did the 20 points question. I don't know if you still remember, yes or no. I'm trying to get that one. 20 points question. So like I'm on textbook page 425. We did this in class. So something, you know, like, hey, if your direct labor cost increase by 10% and then fixed cost will increase by this, how will this affect your operating income? So something like that. Make sure you know how do you get the proper calculation number. I think you will also have kind of a question from either from here, from the, I don't know, but make sure you read changing business condition. You definitely will have a question. You definitely will have a question from a multi-products, the bundles. You definitely will have a question. We have practiced a lot. You definitely will have a question from this part, okay? So kind of a 3 steps. First, you got your weighted average contribution margin per bundle. I hope you still remember when I say something, you know, oh, I know this, you know. Got your weighted average contribution margin per bundle, and then got the break-even point units for the bundle units for the overall. But the question may ask you, hey, for each specific product, what is the break-even point in units? You have to time their weight. You have to time their weight. I'm not going to repeat any question, but we did some practice like the big coffee, small coffee, you know, kind of big frame, small frame, and then the USB driver, you know, kind of those different things. So make sure you definitely will have a question from a multi-product this break-even point. Last thing in chapter 7, we talk about margin of safety. Calculation is straightforward. So let's say, hey, your current sales is 100,000 units. Your break-even point is 20,000 units. How many? Current is 100,000 units. Your break-even is 20,000 units. How many units the sales can drop before reaching break-even point? Then it's 80,000 units. So if it's dollar amount, then you use dollar amount. The idea is margin of safety. How big the margin is when you are still safe. When we talk about safe, is before you start having loss, which is the break-even point. That's we call it a margin of safety. Margin of safety. Okay, margin of safety. We want the margin to be large. Large means you have a more freedom to, you know, lose your revenue. Okay, so basically that's the main thing in chapter 7. I personally think, I personally assume my students will do good on this chapter. I assume you do well in other chapters, but chapter 7 is kind of straightforward. Chapter 8, personally, I think is also a good chapter, but you have to get the concept. You have to get the concept. Chapter 8 talking about relevant cost and short-term decision making. So make sure what's the meaning of relevant. What's the meaning of relevant? It has to happen in the future and then makes a difference. Makes a difference. So it can be with numbers, quantitative. You know, you buy Honda, you buy Toyota. One is 10,000, one is 12,000. So there is a 2,000 difference. But some it can be also qualitative. One is red, one is black. So the color also is different. We said when we do this, we should use CVP analysis. We never ever use a fixed cost per unit. You should know this one. And then we also talk about, hey, sunk cost is never relevant. You never cry for the spilled milk because, you know, no matter what you do, you cannot get the milk back, right? Unless some magic happens, but it's hard, right? We didn't talk about 8.2, this learning objective. You do not need to know that one. 8.3, we start using the relevant information for different situations. So first situation is we take a special order, yes or no, right? We take special order, yes or no. The concept is, let's say, hey, I usually sell this red pen at $10. I usually sell it at $10. But now, and then the variable cost to make it is $6, okay? Now the professor came to me and said she wants to get this pen but only offers me $8. So should I sell her this pen $8 just for one-time special order? My regular price is 10, but you don't use your regular price. You just think about it. Hey, I sell it to her, my incremental revenue will increase by $8. My incremental cost will increase by $6. So it's not a big deal, right? I still earn $2 as the relevant operating income. We assume fixed cost is the same. You know, if fixed cost changes, you have to also do analysis for the fixed cost. But I just give you a very simple example. We don't use the full absorption cost. We just compare our relevant, which is also incremental revenue, and relevant or incremental cost. If you earn more, then you pay more. Then if you earn more, if you earn 8, you just have to spend extra 6, and then you should take the order. Okay. The second situation is, should you discontinue a product, yes or no, right? So you have different products, you figured out, you found out that, hey, some products, they earn money, some products overall operating income is negative, maybe you should discontinue it. But the main concept here is avoidable fixed cost and unavoidable fixed cost. So let's say, hey, you make this red pen, you make this green pen, you know, you found out that, hey, red pen overall is positive $10, green pen overall is negative $5. You're thinking about discontinue this green pen, but if you discontinue this, if you discontinue this green pen, you will lose the contribution margin, right? But doesn't mean if you discontinue this green pen, you will save fixed cost. Some fixed costs can be saved. Like I say, if you don't make this green pen, you don't need to have the equipment. So the depreciation expense, like I say, can be avoided. But the rent, maybe the insurance, you know, the tax is not avoidable, no matter you discontinue this green pen, yes or no. So in that case, you have to separate your fixed cost to be avoidable and unavoidable. And only avoidable will be relevant, okay? Only avoidable, they are relevant. The unavoidable, no matter you discontinue it, yes or no, you discontinue it, you pay $10 tax. You don't discontinue it, you pay $10 tax because it's unavoidable. You cannot avoid a penny. There is no difference. There is no difference. So it's not relevant. It's not relevant. That is the new thing here. Some students are kind of confused with, avoidable is relevant or unavoidable is relevant. Avoidable is relevant. Okay, avoidable is relevant. Okay, I'm not going to talk about detail. I think you have each specific situation in the My Accounting Lab. So I'm not going to do the numbers now, just to give you some idea, you know, how to prepare, what's important. So we said the general idea is if contribution margin loss, if you discontinue this blue pen, this green pen, goodness, if you discontinue this green pen, you will save $10, you know, from the depreciation expense, but you will lose $12 from contribution margin. So you lose $12, you only save $10. Should we discontinue, yes or no? We should not, right? We should not. Next one, talking about when we have the resource constraint, most likely like a machine hour, labor, you know, we don't have unlimited resource, we only have limited resource. Let's say you make this red pen, you make this green pen. Red pen, each one contribution margin is $3, green pen each one is $1, you know, but you only have a limited machine hour. I say for 1 hour, you can only make 1 red pen, but you can make a 10 green pen. So for 1 hour, contribution margin will be $3 times 1 unit. For 1 hour, green pen will be $1, but you make 10 units, right? So you should use the green pen. So that's kind of the concept. But I think in the class, we talk about this one. We talk about this one right before the spring break. You know, when I saw you sitting in the classroom still, we talk about this situation. We said if the demand is limited, yeah, you should make as many green pen as you want, but if the market only said they want to only use 20 green pens, you make more, you cannot sell, they only demand for 20 green pens. Then you should first finish these 20 green pens and use the leftover resource to make this red pen. We did a practice in class. That was your take-home assignment, I believe. So make sure kind of you double check that kind of question, you know, just in case you will be tested. Next one, last situation is make or buy situation. Very straightforward. You make this green pen by yourself or you buy it from your supplier, right? In this situation, we talk about the overall relevant cost. If you make this pen, overall relevant cost is $10 each. You buy it from your supplier, overall is $8 each. Then you should buy it, right? We should buy it. You look at the costs, we use the smaller cost. Only one important concept or new thing is opportunity cost, right? Opportunity cost. So what's the meaning? If you make this green pen, then you cannot make this red pen. So you cannot earn $5, let's say you cannot earn $5. So that $5 will be your opportunity cost, There are two different methods to take care of opportunity cost. It's the extra cost of make. Because you make this green pen, you will lose the $5. So $5 will be extra cost under make. Or some students use as the contra cost, right? Kind of a revenue. If you buy this green pen, you can make this red pen, so you can earn $5 as your income. So that's contra cost, right? Contra cost. So you can put a negative cost, negative amount under buy. No matter what place you put, you know, as long as it's logical, it makes sense, you will get the same conclusion. But if you put under make, it's extra cost as a positive number. If you put under buy, it's a contra cost, so it's the negative amount to decrease your cost. Okay, so make sure you get that kind of concept. I personally think chapter 8, as long as you understand concept, you practice, you are very careful, but you don't overthink, you should be okay. Chapter 9, honestly, this is the chapter I kind of worry a little bit because this is the chapter we start doing this. I don't want to say good or bad, but we start doing this online teaching, you know. I don't know you like online teaching, yes or no. But well, you are lucky actually because it's an open book. So this table is also in textbook, but this table is definitely very, very important. This table is definitely very important. Some background, I'm not going to say too much. As I keep saying, open book, I expect you to get all the concept question correct. And then what's the meaning of a master budget? It's you budget everything of your company, right? So you have two main things to budget. One is your operation. So like from your sales, once you get your sales, how many units you have produced. So how do we get direct material, we pay direct labor and the manufacturing overhead. We also have other operating expense period, CEO salary, salesman salary, those things. And then from that, you got your revenue, you got cost of goods sold, you got your period cost, you got your budgeted operating income. So this gives you the operating budget, gives you budgeted income. And then you also have a budgeted balance sheet, right? Basically, it's the cash. Textbook also told you how about account receivable, inventory. Don't worry about that. You just need to get the cash, okay? Cash. We have 3 budgets under financial budget: capital expenditure budget, cash budget, and then we have 2. Cash budget, you have cash payment and cash collection, right? And then from there, you get your budgeted balance sheet. Okay, so financial budget give you budgeted sheet, balance sheet. Operating budget gives you budgeted income statement. Okay, but you are lucky you have this table with you. So, sales budget, we say this is your first budget. You cannot do anything else unless you have the sales budget. Concept is straightforward. Basically, what's your budgeted revenue is depending on budgeted units you want to sell and the budgeted selling price. The only thing textbook told you is you have to separate your sales budget to cash sales and credit sales, because you will use those 2 items later when you prepare for other budgets. Once you have a sales budget, you can start thinking about how many units to produce. We said the production budget is a little bit different from your sales number because you have an ending inventory and you have beginning inventory. Let's say you assume to sell 300,000 units. Let's say toilet paper now, right? In this crazy situation, everybody wants to buy toilet paper. So when you produce, actually you sell, you will be 300,000, but you want to have a little more on hand. So you will have the, the safety inventory, kind of that. So you say, hey, instead of just to produce 300,000, I want to produce a little bit more just in case the demand is high. So you want to have a little bit ending inventory. So your sales plus your ending inventory will be the units you needed to produce. But you also have some beginning inventory from last month ending inventory. So you subtract that one, you will get the units needs to be produced. Sales units plus your ending inventory gives you total units you need, minus your beginning inventory gives you the units you will produce. How do we get ending inventory? Ending inventory is the percentage times your next month sales. So let's say this month you sell 300,000 units toilet paper. Next month, you plan to sell 400,000 toilet paper. So you said, hey, I want to have 10% of next month as my ending inventory. So your ending inventory will be 10% times your 400,000 of your next month. Beginning inventory is the percentage times this month units. This month, you are going to sell 300,000 units of toilet paper. So beginning inventory will be 10% times your 300,000, okay? Because the beginning inventory, the beginning inventory for this month is your ending inventory of your last month. I explained this in the lecturing video. I'm not going to repeat. If you understand that, that's cool. If you don't understand, you have this formula just right next to you in the exam. So make sure you get the right number. You definitely will have a question. From this production budget. Another thing I just want to say very briefly is if I let you do the quarter budget, end of the first quarter is also end of March, right? You don't add January end, February end, and March end. March end is also the end of the first quarter. Similarly, beginning with the quarter is also the beginning of January. So January 1st is the beginning of January. It's also beginning of the first quarter. If you watched my video, you should know what I'm talking about. Okay, if you watch my video, you should know what I'm talking about. If you don't know what I'm talking about, go back to watch my videos then. Then we also have direct material, direct labor, and manufacturing overhead. As I also mentioned in the video, you don't need to know the calculation. If I ask you any concept, just read textbook, general idea. So if I ask you in the exam, you can get the answer very quickly. Next one, we said operating expense, right? Like CEO salary, salesman. But there is one thing is related with our credit sales. We call it the bad debt expense. Bad debt expense. If you have learned financial accounting, you should know this. This is the money you cannot collect from the credit sales. Okay, this is the money you cannot. So how do we get our total credit sales? Remember. We did our credit sales, right? I put it E, you did your credit sales when you made your sales budget. Okay, so we said, hey, your credit sales total is 100,000. You estimate 1% will never be collected. So your bad debt expense will be 1% on the 100,000. Will be just 1,000. Okay, next thing. So we are done with our operating budget. From operating budget, we got our revenue, we got our cost of goods sold, we got our period cost, we will get our budgeted income. Now we go to our financial budget. Okay, we go to our financial budget. The first budget we will do is capital expenditure budget. Capital expenditure budget. You only have this when you have a long-term assets. When you have a long-term assets, you are going to buy a car, buy a truck, buy equipment, buy land, you know. You only have this budget when you have long-term assets. When you buy material, when you buy inventory, that is not a capital expenditure budget. Okay. So if you buy anything, you just budget it. You say, hey, I'm going to buy a piece of land costing $1 million. So in January, so your January capital expenditure budget will just be $1 million. That's it. But you should know when will you have this capital budget, a capital expenditure budget, when you have a long-term assets. Okay. Next one, cash collection budget. You definitely will have a question from this part. You definitely will have a question from this part. So when will we collect our cash, right? So you sell things in January, February, March. Question may ask you, hey, what is your cash collection in March? You say, why I do this? Because when you sell the products, you give the customer credit sales. So you do not really collect all the credit sales in that month. Some credit will never be collected. It will be bad debt. Some will be collected the next month. Some will be collected 2 months later. So your March cash collection will be different from your March sales. I'm not going to repeat. This is important. I think you also have some practice in the My Accounting Lab, but general idea is cash collection budget is if you have a cash sales in that month. So let's say, so your cash collection, if you have a cash sales in March, your cash sales in March, then that's definitely is collected, right? That's already cash. And then credit sales in that month, let's say March, you also give credit sales, and then you assume 20% will be collected the same month. So 20% of March credit sales will be collected. And you also have your credit sales collected from prior month. So February, you give them credit sales, and then you collected this part in February, but you will collect some in March. So March collection includes February credit sales. Similarly, in January, you know, you credit sale in January, some will be collected in January, some will be in February, some will be in March. So your March collection also include the credit sales collected for your January credit sales. Okay. As I say, I'm not going to do the numbers, but this is important. Even I teach the accounting students, this is important for CPA tests. So make sure you get cash collection budget. Cash payment budget, easier, you know, but similar idea. For direct material, when you buy things, you pay the same amount, right? Sometimes you pay the same amount, so your cash payment includes your this month purchase. but sometimes you don't pay until next month. So so let's say, hey, you buy things January, February, March. So let's say in March, you bought things, material, so you pay in March, but your February purchase part will be paid in March. So your March payment includes your February purchase. Okay. Direct material, the same amount. People don't want to wait until next month. So you use me, you have to pay me immediately. Manufacturing overhead, we said you do some adjustment for the semi-annual payment of tax and insurance. But the main thing is non-cash items, right? Non-cash items. Depreciation, bad debt expense, depreciation, bad debt expense. Those are your expense, but they are non-cash. What does that mean? Depreciation, I say, hey, every year you bought this equipment, every year I depreciate $10,000. So $10,000 will be your depreciation expense in your journal entry, but you do not really lose cash, right? You are not saying, hey, I pay from my pocket, I lose $10,000 cash from depreciation. No, depreciation expense is just an artificial accounting expense. So it will be in your manufacturing overhead, the budget, the expense income budget, expense budget, but it will not be in your cash budget. It will not be in your cash budget. So your cash budget doesn't have this depreciation expense or the bad debt expense. They are non-cash items. They are non-cash items. So you have to do other adjustment. Some students said, hey, professor, I don't know how to do this, do the adjustment. Give me just 2 minutes. I'll show you very quickly. I'm not sure you have this in the exam, yes or no, but this is important. So I want to show with you. Let's say I'm on page 527. Okay, sorry, too big. 527. So this is operating expense. Let's say your January, February, March. So you have this expense, $142,800. This is the expense. Okay, this is expense. Positive number means expense. But depreciation, we said, is not cash. So you do not pay cash. You have to deduct, you have to less, you have to subtract it, you have to deduct it. So your cash, your cash payment is not 142.8 thousand. It's actually you have to deduct this 6,000. Your cash is 6,000 less than 142,800. And then you also have bad debt expense. This is expense, but it's not cash. So when you do your cash budget, you have to less it, you have to deduct it, you have to subtract it from your expense. So you have to subtract the 4,800. So your cash payment is only 132,000. Your cash payment is much lower than your expense because of this non-cash item. Okay, so your cash amount is 12,800 less than your expense. So depreciation expense, bad debt expense, they are your expense, but they are not your cash payment. Okay, I think I talked too much, but that's all I want to say about to review your second exam. As I said at the beginning, this is just the guideline. You don't come to me and say, hey, professor, I only did this, I didn't get A or B, you know. This is just a guideline. I will say you really have an open book. I really assume you will get the concept properly, correctly. You do the multiple choice. If you have a time, you know, do multiple choice, get some idea. You review all of your assignments, my accounting lab, you know, the quiz, those things to make sure you get the numbers correct. You know, you watch the video. As long as you do everything, I personally think will be fine. I personally think will be fine. As I say, I will show you the point allocation for each chapter definitely by Thursday. So just email me during the weekend, even next Monday, whenever you have any question, I can have an extra office hour on Monday, or even Tuesday morning, you know, you still can ask me questions. Just let me know whatever you need me, okay? See you next time. Bye-bye.